this situation. Okay. So we were talking about these different entities, and what I want to do is put a little chart that maybe will put those things in place. So we can, like, pardon my total lack of graphics abilities. Okay, what I'm going to put on the board right now is supposed to represent people. So bear with me. Okay, so this is a person. Okay, that's as well as I can draw. Okay, I'm good at accounting, but not at this. Okay, my wife is an artist, not me. Okay, and now we have a situation when we have multiple people. So we start in 2, and I intentionally draw 3 here to specify. I'm not talking about a couple. Here I'm talking about group of people who are partners. So we start business either as one person, which also means husband and wife in the state of Texas as one person, legally. So if that's a couple, it's still here. So it's one person or couple. Or we have group of people. So 2 situations where we can start. Okay. All of them, in both cases, when we are starting, we are going to create an LLC. We are not going to create any other entity. So what we do here is, whether it's one person or multiple persons, we are going to have LLC. But they are called slightly different. This one where I put number 1 in front is referred to as single member LLC. And this one will be called multiple member LLC. It's still a LLC. There is really no difference between them. The only difference is there is either one owner, which in LLC language is called member, one member, or multiple members. So one member LLC, multiple member LLC. Okay, that's the difference at that point. So legal protection is right here. This is at that level. That's where you would talk to your attorney, not to an accountant. That's attorney's area. So attorney will be at this level providing legal protection. So I will put here is, okay, legal is here. Your asset protection is at that moment. So it may be created as a traditional simple LLC, although it may be created as one of those serious LLCs that we mentioned before. But this is where legal protection is. From there, we need to make a decision, and I will even draw a line here, because above that was legal. Below that, we are talking about taxes. Now, taxation for this guy, for the federal government, for the IRAs. What we do with taxation. Now, those have choices. So, if we have one member LLC, one option at this point will be what it's called disregarded entity, which really means nothing. Okay, that LLC, the term disregarded entity means exactly how it sounds. The IRS says, I don't care. As far as the IRS is concerned, LLC does not exist. If you look at the tax return of this person, the LLC is nowhere to be seen on the return. You cannot, where is the LLC? Nowhere. Why? Because it's disregarded entity. So, another option here for the same guy would be, he may decide to treat this thing as one of the corporations, S Corp or C Corp. That will be an election. He will have to do that intentionally. So this one is silent, I will use the word. Not proper legal term, but if you don't do anything, then that's where you are. This is election. You have to make a specific choice to be S Corp or C Corp.
When you form it.
When you form it. You can do it later. You can later apply for a change of status. Go to Uncle Sam and I'm saying it was not corporation before, but I want to change my designation as a corporation. That is possible. Yes, ma'am.
So you can change every single year, or?
You In theory, the question was, can you change every single year? In theory, yes. Practically, you wouldn't want to do that. There are undesirable consequences if you do that. And one thing you really cannot do every year is changing between S Corp and C Corp. Between them, it gets more complicated as far as timing of choices. But the point is, yes, you can change later, but generally you would not want. See, my early example was I kind of was comparing forming an entity with marriage. Same concept here, like, can you divorce and get together every year? Well, in theory you can. It just gets like, guys, make up your mind. Are you together or are you separate? You know, so that's the same concept. It's like, you can, but you kind of want to stay the course once you decided where you are going. Okay, now we're talking several people, group of people that if they do nothing, that silent choice, then they become partnership for the federal government. So their default choice is partnership. So if there is nothing, no documents filed, nothing done, this is the silent option. Now, and they, just like this situation, they can choose to be treated as a corporation. They also have this choice. But just like for a single person, that would have to be an election. And looking one more time at this picture, okay, this is what we have. One person in the state of Texas creates single member LLC. Multiple people create multiple member LLC. Any group of people except spouses. Spouses are here. Married couple is just like one person. Okay. And legal protection is at that level. After that, whether you create one member, single member LLC or multiple member, then you have tax consequences. Taxation is at a federal level, which has nothing to do with legal protection. So those same LLC that we created choose how they are taxed. If you don't make a choice, single member becomes disregarded, multiple members become partnership. If you make a choice, you can voluntarily become treated by federal government as one of the two types of corporation. Does that picture help? Is it easier now?
Yes.
Okay. Then as far as I'm concerned, I'll tell that we covered the topic and we'll move to other things.
I have one question.
Sure.
You said, I know you don't want to get deep into it, but the passive and active income sort of thing. What if you have some flipping or wholesaling as well as rentals? Do you really need to sort of create two?
The question mentioned terms of passive and active incomes, and things like that. That has to do with taxation. So let's switch to our taxation
Well,
part.
I meant from the.
And once we talk about that, we'll try to, come back and mention those situations. So we're looking, okay, right now in different, before we do that, let's mention one thing which also kind of falls into structuring business. That is that one green thing that we mentioned was self-directed IRA. Let's comment about that. So everybody knows what IRAs are. Your individual retirement accounts. And when we say IRAs, it actually doesn't have to be IRA, any kind of retirement accounts. It could be 401k, it could be SEP, it could be all kinds of accounts. There are a wide variety of plans. So we call them IRAs, but really any retirement plan, any entity which holds your money for retirement. Okay, so all of them standard, if we don't do anything, the traditional type of handling, where your money is. So you put them in that account and then where that money is. Like, it's not in the bank, so what is the traditional place?
The stock market.
Yeah, well, stocks, bonds, mutual funds, right? Those are standard options. That's what you see on them if you look at the statements from all of these variations of plans. So this is traditional situation. Self-directed, again, it's not a different type of situation. Just like we talked here, taxation made it corporation, but we did not changed the company, we changed how it's taxed. It's still the same LLC we always had. So if we had an LLC choosing to be corporation, it's still an LLC. So if we take self-directed IRA, it's still an IRA. If we have self-directed 401k, it's still 401k. All of the same rules as they apply to IRAs, Roth IRAs, 401ks. The rules are the same. The only thing changes is what is held inside. So when we call self-directed, the difference is we don't tell in some investment companies, okay, put my money into stock market. So I trust you to do that, do this, and then we sit back and watch what is happening with our money. Okay, maybe they, climb up, more likely they are not, but, we are passively looking at what our investments are doing. Self-directed means, okay, we are taking control, and we're saying, you know what, I am going to tell where my money is invested myself, by my own investments. Now, when people say, okay, self-directed IRA means real estate. No. Self-directed IRA does not mean real estate. Self-directed IRA means you are investing your own money. Can you put it in stocks, bonds, and mutual funds in self-directed IRA? Yes, you can. It's not, you don't need self-directed IRA for that, because you could do it in normal IRA. But self-directed IRA simply means that you are making your own decisions. So if you put money into self-directed IRA and do nothing, they are going to sit in cash, earning absolutely nothing, just costing you fees. So that is not a very productive way to go. Your own decision means, okay, I have that account, I have money, now I'm deciding what to buy with this money. So yes, you can buy, of course, stocks, mutual funds, and all of that. But the good part about it is once you open the door and saying, yes, I am making my own decisions, you now can put that money into things where standard IRAs are not venturing. Now, the question is why they are not venturing there. That's a good question. Because IRS does not prohibit any kind of IRA investing in anything. IRS prohibits very few things in IRAs. Very, very few things are prohibited. Almost anything you can invest in. So why at work, like at work you have 401k, why don't they invest your money at work, your 401k, in real estate? Buy apartment complexes using funds from your entire company 401k. Question is, can they do that? The answer is, well, legally they can. Like, it's not prohibited, they can. But they will not do that, because then they're taking all these risks with non-traditional investments, for which if something happens, they will be in too much trouble. But it's not prohibited. That's like misconception that people say, well, like my 401k couldn't do that. Well, technically could. Practically, they will never touch it. So if you want to do something more risky, less traditional, which real estate certainly is, then you have to take your own control and say, okay, guys, I understand you are too chicken to do that. I will do it myself. So let me blow my own money, and I will blame myself, not you, when everything disappears. And they say, oh, fine, you want to do that? Great. Here is your money, do whatever you please. And whatever you please is generally two things. You can buy businesses and you can buy real estate. That's what people do with self-directed IRA. You can buy businesses and you can buy real estate. What kind of real estate? What is okay? Same real estate that you can buy without IRA. The only difference is not you are buying that, your IRA is buying that. Now, problems with that is there are rules that this guy put on your self-directed IRA so we don't go too wild and too crazy about that. He says, wait, he said. That's your retirement money, right? So we have your retirement money and we have you. So he said, we better put a wall here. You are here, your retirement money are there. You cannot kind of like cross over that bridge and start like using it. Oh, but I'm kind of working. No, there is no I'm kind of working with his money. Okay, That money is in IRA, this money is yours. And there are things which he calls prohibited transactions. So there are a lot of things that you cannot do. So some people saying this, oh, wait a second, this is great. I can put my money into my IRA. I take that money, I go buy a piece of land, build a house myself on that piece of land, sell that house, put money back into IRA. Yeah, it all sounds good, except when you ask him, no, that is prohibited transaction. You cannot do things like that. So I'm not an expert in self-directed IRAs. Like if you need more on that, we have at the Realty Investment Club of Houston, there is a group that meets on the same day we do, well, where you can have an expert, Scott Blair, talking about that. There is a company, Entrust, in Houston, which is very well known and very popular and has a lot of free education, tons of seminars that they do and free training for people and good networking. And there are other organizations in town, competitors who do self-directed IRAs. So if you want to know more, like, don't ask me, go to these companies. You know, like Mid-Continental, Scott Blair's company, or Entrust, or somebody else, and talk to people who do that, who deal with self-directed IRAs. So why would people then do that? So as long as you follow the rules, like those rules about prohibited transactions. So if you are staying within the rules, what you can do is this. Let's assume that your IRA bought a house, sold it for a huge profit. What happens if you did that? Got a house, you know, put 100 grand on your pocket in a real good flip. Okay, how much it will cost you in taxes? By the way, let's quick test. You made 100 grand last year on flips. Put 100 grand in your pocket. Now time to deal with Uncle Sam. How much he will want to take away out of that 100? Any idea?
30%.
Well, anywhere from 15 to 40%. So it depends on your total situation. I cannot give you a number, but a good rule of thumb is 1/3, kind of in Indian. He gets 1/3, you only get 2/3. It's pretty brutal taxation, and it could be up to 40% too. Like so, in the worst case scenario, it could be 40%. And when I say worst case scenario, here in Texas, it's not worst case. Worst case, if you did it in a state that also has state tax on top of federal tax now, then you can exceed 50%. So like, be happy we are in Texas where we don't have to deal with the state tax issues. Okay, so, but up to 40% can go, let's say 1/3. So look about that, you made 100 grand and 30 grand have to give up. Not a good proposition, right? If that same thing happened within your IRA, how much you have to give to him? Zero. You see the reason why people are doing that? Well, one problem with that, which stumbles some people, you know, to my surprise, even after they have attended several meetings, talk about self-directed IRA, and somehow missed the very first 2 minutes of the presentation. The very first 2 minutes. But that money is an IRA, meaning what? You cannot spend that money. People saying, oh great, I have 100 grand, now I want to finally buy my sports car with that money. No, you can't. That's not your money, that's your IRA money. That violates the whole idea. So you would be doing that not to improve your lifestyle, but to build your wealth for your retirement or for your children. That's what it's for. Not to play with this money right now. But that's the concept of self-directed IRA, so that's what I wanted to talk about that. Now, okay, we can scratch this one off and we'll go to everything else here is tax issue, so let's talk about taxes. Okay. Just 1 sec.